morning and welcome to another episode of Always Up to Date. I'm Denise and this is Yahweh. And today we're going to be talking about why accounts receivable are important. So as you know, with our videos, we like to have a quote and a statistic. So our quote today is from Peter Drucker. He's a man who wrote 39 business books. And the quote from him is, "Nothing happens until someone sells something." The statistic that we have today is from CB Insights. And so CB Insights reviewed essays from failed entrepreneurs. Most of the entrepreneurs listed multiple reasons for failure. 42% of entrepreneurs who failed report no market for their services or product as one of the reasons of failure. 29% of entrepreneurs who failed report running out of cash as one of the reasons for failure. 23% of entrepreneurs who failed reported not having the right team as one of the reasons for failure. These were the three most common reasons reported. All the other reasons that were reported were less frequently. So like pricing and cost, timing, location, etc. So we're looking at a client who sells a product to a customer, but the customer doesn't pay for it right away. And the client will often give the customer time to pay for the product, and it becomes an account receivable. Mm-hmm. So Yahweh, I understand you have some questions about accounts receivable.
Yes, absolutely. So first of all, we'd like to start, what are accounts receivable?
Yeah, so accounts receivable are basically amounts that are owed by the customer when they've bought something from a supplier, mm-hmm. but haven't paid for it yet. So basically the purchaser has bought the product mm-hmm. on credit. Yeah. So instead of paying it right away, they might have a 30 or 60 day mm-hmm. Time to pay that back.
Mm-hmm. Yep. So as long as you don't have you don't have the payment right away, you got an accounts receivable.
Exactly.
Yeah. What is an example of an accounts receivable?
Yeah, so kind of like what we said. So let's say we have a company who maybe sells stationery supplies. Mm-hmm. And so your customer comes in and they buy $500 worth of stationery supplies, but they don't pay for it right away. So the supplier gives that customer 60 days to pay. Mm-hmm. So once the stationery company receives the order and then sends the supplies to the customer, mm-hmm. but the customer hasn't paid, that becomes an accounts receivable.
Mm-hmm. Items like holdbacks receivable and notes receivable, those mm-hmm. items are also a little bit common. They might be in a separate line item, but normally accounts receivable are the ones that are a little bit more current in nature. Mm-hmm. And I guess holdback would be current as well, but
right.
Holdback is very particular. Yeah. How is an accounts receivable recorded in my books?
Yeah, so once the invoice has been prepared and sent to the customer, we'll go back to the stationery supply company. Mm-hmm. So they've sent an invoice to the client for $500. So they're going to see a $500 increase in their accounts receivable. And now say the customer has 60 days to pay. Once that 60 days is up, and the customer pays, mm-hmm. Then the stationery company will see an increase of $500 in their cash account mm-hmm. and a decrease in their accounts receivable by mm-hmm. $500.
Yeah. On what report is an accounts receivable recorded?
Yeah, so accounts receivable are recorded on a balance sheet. Accounts receivable are considered an asset. Mm-hmm. So basically, the company owns that money, they just haven't received it yet.
Mm-hmm. Yeah, and I don't know, from our previous video, we've talked about how balance sheets are listed, mm-hmm. and accounts receivable are one of the more liquids one in terms of current assets, so yeah. They'd be at the top of the balance sheet, yeah. Almost close to the cash.
Yeah, basically you're expecting your accounts receivable to come in within the next 12 months.
Exactly.
So, yeah.
What happens when the accounts receivable goes down?
So when once the customer pays the bill and the accounts receivable is decreased, it's considered a source of cash. So then we're going to see on a company's cash flow an increase of the cash or their working capital.
Right. Another item that might reduce receivables are writing off for bad debts. So anyone whose policy is to write off bad debts when you realize it is you're able to write it off as an expense in your income statement. So if you don't see the cash, it might be in your income statement, decreasing your income or your profit. So that's bad debts. And some companies do have a policy called an allowance for bad debts. This is something that normally a company would realize if they have a pattern of seeing credits not being paid off right away. So those are some of the reasons as well why your accounts receivable would go down. What happens when the accounts receivable goes up?
So when the receivable goes up, it's considered the use of a company's cash. And so then the cash flow is kind of, in a sense, it's just stretching out the cash that's being used and the time that it takes to receive the money. And so the company uses up their cash more quickly. So they're,
And sometimes it could be the timing.
Right.
People who would bill at the end of the month but not necessarily collected on the same day. If you look at your balance sheet in a monthly basis, you might be able to see always a high receivable in your account, but really they're being collected on the 15th day and they're just being billed on the 30th or the 31st. So the receivable would always show there, but you wouldn't see the cash flow coming in and out in that way.
Exactly.
And this is something that we might want to look at too, because having a high receivable meaning for a long time, and if you look at them and they're mostly more than 60 days past due, then maybe you should have a policy of when, because we might have a collection problem. Are uncollectible receivables an asset?
Good question. So uncollectible accounts receivable are not considered an asset. So they get reclassified as bad debt. And so, companies usually only allow like credit-worthy customers, right, to have it. So you don't want somebody that you know isn't going to pay. You usually ask for cash up front. But companies that you know are going to pay, those are the companies that you'll allow to have accounts receivable in your company, just because you know that they're going to pay eventually.
Absolutely.
Hopefully within that 12-month period, but usually 60 days to 90 days.
I mean, at the end of the day, all we want, like, we're here to make money. So
that's right.
If it's uncollectible, maybe we should address it.
Exactly.
Absolutely. Why do accounts receivable matter?
So again, it goes back to the working capital. The account receivable is included in that working capital. So if it's too high, the company might be lax in collecting their AR, and then soon they're going to be struggling for cash. Right? That's we all know that's where you get your cash from, is from your customers, right? And if it's too low, you might be sort of unwisely harming your customers and not allowing them to have that time to pay, that little bit of extra time or whatever. And so they might go somewhere else to get the same supplies, but being able to pay it on a 60 or 90 day term.
Absolutely. How long does a customer have to pay the AR?
So we kind of talked about it a little bit. I mean, if you don't get the cash right away, it's considered AR. So whether they pay it a day late or later, or 10 months later, it's an AR. But normally companies have 30 or 60 days. That's the normal Time, again, there's, you could do 90
Yeah.
90 days.
I think it varies on the industry that you're
does.
in, and that's the stuff that you have to think about, especially for if you're not expecting to collect in the next month. You still have to operate within those time periods. So that makes it a lot more important for accounts receivable to be tracked. And again, you're risking your cash collection based on your customer's credit. So there's a little bit of risk in there.
That's right. Yeah, exactly.
How does the customer record the AR they receive from the company?
Yeah, so once the product has been supplied to the customer and an invoice has been given to them, then it becomes an accounts payable on their records. So that's how they would pay that. And we have another video that we're going to talk about the accounts payable. But
yeah. So that, I think, if I know some companies would loan their customers a huge amount of credit, and I think that would be something to look at if they're accumulating a lot of accounts payable. Maybe there's a credit issue with this supplier. You might not go. Yeah. So I think it's important to know too where to look for that in your customer's side of financial statements.
Right.
Yeah, and I think that's all we have today. Thanks for joining us today. And if you have any questions or comments, please write your comments down below, and we'll try to get to you as soon as we can. Hit like and subscribe if you like our videos, and we'll see you guys next time.